So the other day I got into this surprisingly heated conversation. I said paper money isn't actually backed by anything anymore, and the person I was speaking to just looked at me and said, "That's not true. Money has to be backed by something." And that right there inspired this video, because that's one of the most misunderstood ideas in finance today, that our modern currencies somehow still have a link to something of worth, like gold. But it doesn't. And the story of how that happened explains why gold still matters and why I think it deserves a place in your portfolio. And if you get anything from this, would you consider subscribing to the channel? For most of modern history, money was backed by gold. The US dollar was once redeemable for a fixed amount of gold. You could literally trade your paper for the metal. You could go down to the bank and do that. But that changed in 1971 when President Richard Nixon ended the dollar's convertibility into gold. It was called the Nixon Shock. Overnight, the world's major currencies became what we now call fiat money, money that is backed by governments and not physical assets.
I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
Then not long after that, the UK sold off much of its gold reserves in the late 1990s, one of the biggest sell-offs in modern history, just before gold began a 2-decade bull run. So yes, paper money truly isn't backed by gold anymore, but that doesn't mean gold lost its power. Here in Switzerland, the connection to gold never really went away. This country refines around 70% of the world's gold. Think about that. From African mines to Indian jewellery markets, it's all passed through Swiss hands. The Swiss franc is still seen as a hard currency, one that holds its value, and that mindset runs deep in Switzerland. You can feel it in the culture, precision, stability and trust. Gold fits right into that. Gold prices over the past few weeks have recently hit an all-time high, over £3,000 an ounce. When gold rises like this, it usually means something deeper. People are losing confidence in their economy. If the leaders are playing risky games in politics, or the people don't believe in their government, you'll see price hikes in solid metals. And here's the question on everyone's lips. Why does this happen? Because when trust in paper money starts to fade, trust in precious metals like gold and silver tend to rise. So if paper money isn't backed by gold, why do people still care about it? Well, because gold has what financial experts call intrinsic scarcity. You can't print it and you can't duplicate it. It takes real effort to dig out of the ground as well. And unlike currencies in today's economy, gold supplies grow very slowly, less than 2% a year. But as we've seen with the banks in unexpected times, they will print more money, which makes your money worth a lot less. That's why it's often seen as a hedge against inflation and instability. When people lose faith in governments, banks or stock markets, gold is the oldest form of insurance we have. But let's be realistic, gold isn't perfect. It doesn't pay dividends. It doesn't generate cash flow. So when you think about your portfolio, gold shouldn't be your portfolio. It should balance it. Think of it as a financial shock absorber. When stocks fall, gold often holds or rises in value. When inflation spikes, it preserves its value. Most financial planners suggest something like 5 to 10% of your portfolio in gold or gold-related assets. Basically enough to protect you, not so much that it limits your growth. And owning gold today doesn't just mean physical bars in vaults, though that is an option here in Switzerland. You can also buy ETFs that track gold prices, mining stocks, or even tokenized gold assets. The key is to understand why you're holding it. Not as a bet, but almost as a protection, as something that holds its value when the world is shaken. So back to the conversation I mentioned earlier. The person I was speaking to said that money has to be backed by something, and then I realised what he meant. It's not backed by gold anymore, but maybe he thinks it's backed by trust. Every dollar, every franc, every euro, every pound, they're backed by the belief that someone else will accept it in a shop. But the more that we realise about the money that we work for each day, the more appealing a bigger and broader portfolio seems to be. Gold, on the other hand, doesn't need anyone's promise. That's what makes it so timeless. And that's why it'll always have a place in this conversation. So whether you're in Switzerland or anywhere else in the world, remember this: gold isn't just a relic of the past, it is a reminder of value, scarcity and stability, things our financial system sometimes forgets. Thank you so much for watching. If you enjoyed this video, hit the like button down below and hit the subscribe button too, so you don't miss out on more content just like this. Let me know in the comments below, do you still believe in gold's place in modern investing, and will you make it a part of your portfolio? Speak to you soon. Cheers.